Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have the frac spread show. We're going to go through our normal frac spread count, talk a bit about oil demand, where we sit right now, and then just a quick highlight on some recent data that came out from the US. Nothing major, just just a quick update. So one of the key things when you look at the numbers, because the frac spread count went from 270 to 266, there's a bit of a shadow effect that happens when you look at some of the weather issues that happen from one to the other. Then you had the adjustments that were made between last week and this week. And that's why it's a quick drop, and then we should see that shift back up like we had in the rig count. The rig count, if you remember last week, had a big drop. Now you're having a big snapback. It's going to be something similar where you get some of this reverberating movement back up. So realistically, we went from 270 to 266, and we should go from 266 and really leapfrog right back into 280, just because the drops really came from Western Gulf, Permian, and those are things that should start to adjust a bit higher. We did get some other small reductions in some of the smaller basins, but we did get an increase in our other calculation, as well as another small improvement in Appalachia. So again, just a lot of movement. This normally happens in February. A lot of it's driven by weather. A lot of it is also driven, I should say, a mixture of both weather as well as just repositioning for the more of the spring push, and we see that in rigs. You have movements. So stuff comes down, equipment comes down, it gets moved to the new location, and then you start to see that ramp up. And we're in the midst of it right now. So there's really nothing in this is making us say, crude production or gas production is coming down. Quite the opposite. It's just, again, a rejiggering of positions. If you think about a chessboard, or if you like Risk or Stratego as I do, it's just moving the pieces around on the board to enable companies to, again, meet their quotas and make sure that they hit the production numbers that they've guided to. Now, when we look at the rig count, here's where you can see oil had a big bounce by 10, gas had a drop by 8. But when you look at the horizontal rigs, and this is some of the key pieces that we always talk about, horizontal rigs stayed flat. And that's where you really have to hone in on where are things changing. So directional was up by 5, vertical dropped by 3. But again, horizontal staying very firm. And that's where we continue to see a lot of this presence, and why we see a lot of this stability when you look at DUC counts, when you look at activity. Of course, the horizontal rigs still remain flat. Louisiana picked up 6 rigs. New Mexico picked up 4. Texas dropped by 7. So again, that's a lot of that repositioning that we've talked about. There was that cold snap. Some things had to move around. Some of those movements were a bit delayed because of the weather, and that's where we will see some of those movements coming back and forth. Quick update on the crude markets. Russia plans to cut its oil output by 500,000 barrels a day, and that's a retaliation over Western sanctions. How much of it is a retaliation versus how much of it is they physically can't keep production where it is today? Probably a mixture of the two. Never let a bad situation, what is it? Never let a opportunity go to waste. And here it is. Like they're going to, even though we don't think there's a way that they can maintain current production anyway, might as well claim that it's a retaliation against, sanctions. But when you look at it in general, it further tightens supply with, when you look at the underlying cuts, they're already well below quota. So again, any kind of adjustment, it'll be interesting to see how much this shows up. These are two important charts when you look at their breakdowns, because Russian fuel exports slow down, which is what we've been talking about. And a lot of the reasons why they've lost a lot of this is obviously the EU 27 and the UK were the largest buyers of diesel and gas oil. And as of February 5th, that has gone away. Excuse me, a lot of this is now going to end up in other markets. We see it in Africa. I think one of the key ones that we're also going to see is more Latin America. So we should see Latin America, the Middle East, Africa, and then Asia pick up a lot of this. But again, it's still going to weigh on opportunities, because if there's only so much port space, there's only so many slips. So if you're already relying so much on crude exports, now you have to rely on product exports. Well, something's going to have to give. You're either going to have to reduce your crude exports or you're going to have to reduce your diesel exports. And if you reduce your crude exports, well, that means you have to increase refinery run rates. But where are you going to store the product? And that's when you start looking at the balancing act that we're essentially pushing down onto Russia, which is why it's not surprising to see them have to cut, given the decisions that they're going to have to make in terms of running refiners harder, trying to export more product, or just focus on actually reducing refinery runs, reduce the amount of diesel that's being exported, and try to maintain those crude exports. So even though the production numbers could be coming down, there's a good chance that exports could stay the same, and that's going to be the important piece to watch as we go down this rabbit hole of what does this mean and how is it going to show up in the market. Now, another key piece: China's oil imports are still depressed. We talked about it in the in the EIA show. Even though they're coming back, they're still below where they were in 2022. So we don't see that adjusting too much. When you look at passenger traffic, airlines in total, things are still low. Even though they obviously had their recovery based on Lunar New Year, it's still not back to where it was. And that's, I think, some of those key pieces that we continue to see. Global oil demand, when you look at the long view forecast, they don't have this big spike up like the IEA, OPEC has. And we've alluded to something very similar where we just see things being fairly stable. There will be some increase just because of NGL consumption, just again, natural gas liquids and the liquid side in general. But as every incremental barrel comes, and refining capacity comes up in China, we see additional incremental barrels coming down in Asia. So that's, again, it's going to be that offset, which I think is really important when you're looking at some of these different pieces in terms of flows. Like, it's not like both are surging or both are declining. It's more of this balancing act, which is why we think that this is a bit more of a likely scenario at this point in time. Now, one of the important pieces when you start looking at the U.S. and you look at 2022 U.S. capacity additions, I think it's really important to look at what is being added in the U.S. And when you look at MISO, you look at PJM, there's a significant amount of solar that's being added in ERCOT outside of the ISOs in PJM. There is some of that gas, but it's important to look at, especially in the New England area, how much solar is coming in. There's nothing else. And the problem with that amount of solar and the amount of new coal and gas that has come offline, you still have solar intensity issues. You still have cloud cover. You still have winter and frost, ice, snow that can hinder some of these pieces, which is why we're seeing such broad swings. And that's why we always call for a balanced approach. You have to look at things from a basket level to ensure that we have this capacity. And that's going to be a problem, especially when you start looking at, some of these solar pieces where how much of it is actually coming on. We've talked about a lot about the difficulties of getting interconnects, the cost of getting them, and the running room in terms of permitting, which is hindering some of these new additions, which is going to be an important one to watch. Now, when we look at some of the expectations for inflation, I think this is important to look at for January. The consensus for inflation is increasing. We've already talked about how we think that there was going to be a bump as we had in January, given the increase in gasoline and diesel costs, as well as some other pricing, which is why we do think that the 6.3% to 6.4% number is very likely as we go through and the data comes out next week, which we'll talk about. Food pricing, global food prices came down a bit more, but as we've been saying, it's still very elevated and it's starting to level off, and we will likely see those increase in the food prices increase over that time period. just because we're coming out of shoulder season. We're coming to a point where fertilizer prices are going to go back up. We have broader shortfalls. We've had a sizable increase again in grain prices, and a lot of this is because of renewed missile attacks from Russia, just showing that there is no friendliness coming at this point in time. There's not going to be any type of near-term ceasefire, so there's going to be that continuation, which is going to keep things problematic on the food front. In the U.S., we had the University of Michigan data. Current conditions improved a bit, sentiment improved a touch, but when you look at expectations actually got worse, and a lot of that is tied to inflation expectations actually increasing. When you look at wages, wage growth started to ease for the lowest earning quartile, but still ticked a bit higher for the highest earners. You should see that gap close. But remember, this is also going to be a pressure because inflation's increasing a bit as wages are actually tracking lower again. And that's going to be a bigger problem when you start looking at, well, how fast does inflation come down to help alleviate some of those pressures. Median wage growth, as tracked by the Fed, came in at 6.1% in January, which was the same rate as in December. So wage growth has been holding fairly firm, but in contrast with the average hourly earnings, which continue to decelerate, latter partly explains by mix shifts with higher wage layoffs dominating. So again, there's that mixture in terms of where things are, but that wage growth, still being elevated. It's coming down, obviously, but not at the same rate, keeping things expensive and, again, keeping some of that inflationary pressure in the market. February update for the University of Michigan shows inflation increasing, which isn't surprising given where gasoline was in January, where diesel was, and honestly where food prices have gone. Because even though food prices on the UN level have come down, they've actually increased on the in the food store, which again offsets some of that pressure, which is why you see some of these numbers actually recovering a touch. Then when you look at wage growth for job switchers, continues to ease. Growth is off peak for job stayers, but declining. So again, it's just job switchers are seeing less and less incentive to switch. It's still high, so you're still going to get that switching, but it's starting to cool off a bit. And then another positive data point, CEO confidence index as measured by the conference board ticked higher in Q1. It's still pessimistic in level terms, but a relatively strong move. And again, it gets to this point, and then we think it just goes sideways a bit as I think CEOs kind of digest how Q1 is setting up, what Q2 is looking like. And I think that's where it's hard to continuously go down, which is why we got to this low point. And then if you look at like the early 80s, if you look at any recession, it kind of gets to this point and then bounces sideways for a bit, which I think is where we're going to see. But it's good to see that at least there's some stabilization in that regard. So that's what we have for you today. We're trying to keep things a bit shorter. Hopefully this is helpful. If you have any questions, you can always reach out to us. You can reach out to me through Twitter, through email, because we always love hearing from you. And we hope you have a great weekend. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.